Hey guys, Dave Keller here with Market Misbehavior. Today it's Thursday, September 15th. The S&P 500 closed right around 3,900. That is a key level of potential support for a couple different reasons, because we've been there before. This is where we bottomed out about a week and a half ago in early September. Also, it's a key Fibonacci support level. Today we're going to talk about why S&P 3,900 is so important. So when you talk about a potential support or resistance level, there's really three different ways, three different derivations of those proposed levels, those anticipated levels. The one would be what I would consider a market-derived level, what we think of as traditional support or resistance. If you look left on the chart, we've hit a certain point and we've tended to top there or tended to bottom there. So when you look at the chart of the S&P, you see 3,900. We've been there before and we've bounced there. So every time you test a level of support or test a level of resistance, it gives further weight to that. So that's the first type, called sort of a market-derived level. The second one would be what I would consider sort of a retracement level. Some technique, commonly Fibonacci retracements are one I use a lot, which is a way to define some sort of range and then identify potential support and resistance levels between those extremes. There are other things like speed lines and other things that are Gann analysis, or sort of outside the scope of today's video. We're going to talk about why Fibonacci analysis can point us right to that 3,900 level as well. The third one, which we won't get into today, is something that's more indicator derived, like a moving average, for example. That's where the market topped out, by the way, in August. We'll look at that as well. Before we get to the chart, if you like this sort of thinking about technical analysis, investor psychology, and market history, if you like that sort of thinking, won't you subscribe to my channel? Also, give the video a like if you appreciate it. We very much appreciate that back. Put a comment below. What do you think the market does? What do you think the S&P does around this key 3,900 level? Let me know in the comments. Let's get to the chart. All right, so I mentioned in the introduction there are three different kinds, what I would sort of generally describe categories of support and resistance levels. This is how we can identify key levels at which you might anticipate the market to have a reversal of some sort. This current chart of the S&P combines two of those. We have what I would call a market-derived level, right? Just looking at where we're at now, looking to the left on the chart, what price levels kind of stick out. And that's sort of a previous peaks and valleys. Where has the market turned before? The argument for that sort of analysis is that the market has memory. If we've turned at a particular level, right? If value investors have come in and bought a particular stock at $12 a share, every time it comes down to 12, I might reasonably assume that the next time we get down to 12, it's a similar valuation. Probably the similar mentality would drive another group of investors, or even the same investors, to once again add to their positions at that same point. It looks equally as attractive when the price gets down to that level. And the same can be said for a potential resistance level. We do have that scenario right now with the S&P and the 3,900 level. If you look at where the market bottomed out about a week and a half ago in early September, is right around 3,900. If you look on a closing basis, the low from May was also at 3,900. That was actually the first time that this level really came into play in 2022. That's where we bounced here into late May, early June. We then undercut that level for about 2 weeks here into the June low. From there, chopped around, rallied up to the short-term peak in August. So now we've come right back down to that 3,900 level, bounced off of there. And today, here on Thursday, the September 15th, we came right back down to 3,900, closed just above there at 3,901. So the market has told us that 3,900 is a reasonable level of support. It's reasonable to assume that we may get a bounce off of that level, which we certainly did in early September. What this also means, though, is what if that level doesn't hold? We'll get to that a little later in today's video, but let's talk about the second type of support, which would be what I would call a retracement level. There are a series of indicators which basically, once you define a range, or if you're looking at the framework of the price behavior over a period of time, you can identify some extremes. So in this case, we can identify the low from June as the beginning of the move, the high from August as the end of the move. And then we're now trading between those two extreme prices. We can apply a series of Fibonacci levels to identify potential levels of support on the way back down. This is why 40-60 was such an important level, in our opinion, in late August, and why a breakdown of that level really confirmed that this was more of a drawn-out corrective pattern that we were in. From there, we went right down to the 61.8% level, which happens to be right at that same price point, right around 3,900, which we, again, rallied to close just above 4,100 earlier this week. From there, we've now rotated back down. We're once again testing the Fibonacci level. Now, with any sort of technical approach like this, trend lines, support and resistance levels, anything, every time we test a level, and again, the same behavior occurs, what it tends to mean is it gives further weight to the significance of that level. It really confirms every time you test it that the market has memory and that it's recognizing the value of that level. This gets us to our painful potential outcome, which is what happens if that level breaks. So two things you can assume when you see a level validated by multiple different techniques. In this case, traditional support, which suggests 3,900. Fibonacci analysis also suggests 3,900. So we have a couple different techniques all identifying that same potential level of support. So two things we can assume as we approach that level in late August, early September. Number one, reasonable to assume a bounce off of that point because it's a projected level of support. It would be more surprising if we didn't bounce off of there, to be honest with you, because it's such a clear retracement level between those two extremes. We did, of course, indeed get a bounce as the S&P moved from 3,900 to just over 4,100 in less than a week. From there, though, we've now once again tested that level, and this gets us to the second point. After you get a bounce, the break of that level, if and when it would occur, the more that you've tested it, the more significant a breakdown would be. So now that we've bounced off this level 1, 2, and then we'll call it 3, 4 times if you include the current observation means, if and when we would break down through that level, that would indicate an even more significant breakdown of momentum as opposed to if we just tested it like once or twice. You can also, to be honest with you, look at the bounces that we saw in June. So while 3,900 served as support in May, it served as resistance there in late June and early July, which means when we finally broke above that level of 3,900, that really confirmed the swing to the upside. A break below that 3,900 level really could indicate potential move to further downside. That third type of support and resistance, by the way, is what I would call an indicator-based level, and a moving average is a common way to do that. That's when we have focused in our work on the tests of the 200-day moving average in August. Pretty reasonable when a price is moving up to the 200-day from below. Expect a reversal back to the downside, and that certainly was the case here for the S&P 500. Now we're below 2 moving averages. Now we're testing 3,900 level, the 3,900 level once again. So in conclusion, this level is important because it's been validated by multiple different approaches, not just like one technique. And this is a level that we drew randomly on the screen. It's based on Fibonacci analysis, but also it's an established level of support. So you have multiple techniques telling you that 3,900 is pretty important. That means two things. Number one, we most likely get a bounce off that level, which we have already experienced. Number two, if and when we get a valid break below that level, that could indicate much further downside potential. If we break below 3,900, that's the question, is what's the next downside objective? What do you think is the next downside objective? Let me know in the comments below, but I'll tell you my quick take on it. Number one, I think that seriously opens the door to two important levels. Number one would be around 38.10, 38.15. That's the longer term Fibonacci level. If you look at March 2020, the low there to the January 2022 high, take 38.2% of the way down. That's this level right here, 38.10. That's where we literally bottomed out on an intraday basis in late May. Then again, that would be the next, short term, that would be the next important level to watch. If we would break that, I think retesting the June lows, absolutely a possibility, which would be just below 36.50. What do you think is the downside objective for the S&P? Let me know in the comments. So there we go. The key with support and resistance levels is to ideally come at them from different levels. I like to use a number of different techniques, traditional support and resistance, but also what I would call market derived levels, but also retracement levels like Fibonacci levels. When you see different techniques all agreeing at a certain price point as having meaning, what I would call a confluence of support or a confluence of resistance often means it's more significant. You often expect a bounce, which we've had in the last couple weeks. But the question then is what happens if we break through it? And what you want to think about is the more we've created a level and then tested it, which you've now done a number of times with 3,900, that means if we break below it, that certainly could open the way to much further downside. Final comment I would make is the other thing that compels me to point out the 3,900 levels. I'm hearing other analysts, other strategists, other market commentators focusing on that level as well. And when I know that more and more people are keying in on a key level, that just validates more and more the thesis I would mention earlier. You'd expect a bounce because so many people are already expecting it. And then if you break, the reason why prices can go lower after that is because if you break a level of support, people start to get nervous when they realize that support level is not holding and they sell their positions. Their selling provides further downside trajectory. As the price moves lower, that fuels further selling, which fuels further down movement, which fuels further selling. That's what we call a feedback loop, a negative feedback loop. As the price continues to go lower, continue to be bullish by bearish market behavior in reaction to that breakdown. So 3,900, the key level to watch. We have the options expiration on Friday session and the Fed meeting next week, which means 3,900 could be a level we watch for quite some time. That's it for today. If you enjoyed this video, please give it a thumbs up. We'd very much appreciate it back. We will be back with you again soon. I'm Dave Keller with Market Misbehavior. Bye now.